To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jelinski, the financial quarterback. Don't touch that dial. Secure Act 2.0 is a mammoth piece of legislation that contains over 90 provisions that affect retirement accounts. While many of these provisions are not game changers, they still can be very helpful to specific groups of retirement savers. One of these is the provision that eliminates the 10% early distribution penalty that applies to net income attributable when an excess IRA contribution is corrected by withdrawal. So basically, let's say you put too much money and you're a little too eager, and somehow you violate the rules. If it's timely withdrawn, the excess itself will not be subject to any further penalties. However, the NIA is taxable for the year in which the excess contribution is made. So let's say, I don't know, you put in $100,000, you make $5,000 of interest. That $100,000, if you correct it, is not taxable or penalized. But if you make an extra $5,000 of income, you got to pay tax on that. That makes perfect sense. And it's a worthy correction. So sometimes some of these laws are good. According to the IRAhelp.com website, the Secure Act 2.0 eliminates the penalty for the NIA. How does excess IRA contributions happen? Excess IRA contributions are contributions that exceed the limit that someone can contribute to their IRA or Roth IRA for the year. Examples of excess IRA contributions include contributions that exceed the maximum annual contribution dollar limit, rolling over an amount that isn't eligible for rollover, or making a Roth contribution when income exceeds the limits. So basically, this is what happens when you make a mistake. NIA is no longer subject to a 10% penalty. So you just correct it, there's no penalty. Excess contributions will be subject to a 6% penalty each year the excess amount remains in the IRA until it is fixed. One way to fix the mistake and avoid the 6% penalty is to withdraw the excess, plus or minus the earnings, by October 15th of the year after the year which the contribution was made. So let's say last year you made a mistake. You have till October 15th of this year for you to not have that 6% penalty. It's way less egregious than the old penalty. Prior to Secure 2.0, the NIA was also subject to the 10% early distribution penalty if the IRA owner was under the age of 59 and a half. Secure Act 2.0 changes the rule. Now NIA is taxable, but not subject to the penalty regardless of age. So for example, we'll call her Lourdes, age 43. On January 7th, 2023, made a $6,000 prior year contribution for 2022 to a new Roth. She later discovered that her 2022 income was a little too high for her to contribute to a Roth. On February 10th, 2023, when her Roth IRA balance is $6,300, she decides to correct the excess by withdrawing it. To avoid the 6% excess contribution, she must also withdraw the NIA. It's basically just the money it earned during that time. When Lourdes takes the $6,300 distribution of the excess contribution, the amount of the excess contribution, so $6,000 is regular, is not taxable. Only the amount of the $300 is taxable and will be included in her income for 2023. However, it will not be subject to the 10% early withdrawal penalty because she corrected it before October 15th of 2024 in this case, because it's the year after the year. If you're looking for ways to trim your yearly tax bill, experts may check your portfolio, since some assets are more likely to trigger taxes in certain accounts. Your 401k account offers tax-deferred growth, meaning you won't owe levies on yearly income, such as interest, dividends, and taxable capital gains. Now, you may owe taxes for selling assets or receiving income in a brokerage account, which may be a surprise for some of you. According to CNBC's article, avoid paying surprise taxes by picking the best investment accounts. It says, I definitely take into consideration when I'm designing portfolios for clients to try to keep the taxability of assets in mind when strategizing where things are going to go. If you have three types of accounts, brokerage, tax deferred, and tax free, you can pick the best spot for each asset. So you have to look at each account and figure out, is this a taxable account? Another word for that could be brokerage. Is this a tax deferred account where you are choosing to defer gains until a later time? Or is this a tax free account? Now, since bonds may have less growth but distribute income, they may not be suitable for tax-deferred accounts like your 401k plan. And investments most likely to appreciate may be ideal for tax-free accounts like a Roth. However, if you don't have the three account options, there may be other opportunities for tax efficiency. For example, if you have a large enough bond portfolio, you may have to put some assets in a brokerage account. But depending on your income, you may consider municipal bonds, which generally avoid federal taxes and possibly state and local taxes on the interest you make. Other assets to avoid in a brokerage account might include REITs, real estate investment trusts, which distribute 90% of taxable income to shareholders, said a CPA, Mike Piper from St. Louis. Marginal tax brackets for the year 2023 married filing jointly. So if you make $693K or over, $693,751 to be exact, you're in the 37% bracket. If you make $22,000 or less, you're in a 10% taxable income. If you make between $22K and $89,450, you're in the 12% bracket. $89 to $190, you're in about the 22% bracket. $190 to $364, you're in the 24% bracket. $364 to $462, the 32% bracket. And $462 to $693 in the 35% bracket. Now, if you have to have funds in taxable accounts, you want to make sure it's generally something with low turnover. Exchange-traded funds or index funds generally spit off less income than actively managed mutual funds, which typically have year-end payouts. Of course, taxes aren't the only factor when deciding where to keep your assets. You'll also need to consider your goals and timeline. There's a tax risk for all-in-one funds. Another investment that's better suited in tax-deferred or tax-free accounts is all-in-one funds, which attempt to create a whole portfolio, such as target date funds and age-based retirement asset. Since all-in-one funds contain different types of assets, there's no ability to put certain portions, such as bonds spitting off income, into a more tax-efficient spot. These investments also limit your ability to use tax loss harvesting or to sell assets at a loss to offset gains because you can't change the underlying holdings. For example, let's say your all-in-one fund is U.S. stocks, international stocks, and bond funds. If there's a dip in domestic stocks, you can't harvest those losses by selling only that portion, whereas you may have that choice if you own each fund individually. That's why I don't like target date funds. I don't like these all-in-one funds. I'd rather you be in 7 to 12 different asset class-based ETFs that are lower cost, institutional grade quality. And if you want to make sure you have an institutional portfolio, just met with somebody the other day, and lovely couple had these funds since the 90s. Two of the funds had no growth in like 20 years. Now, they grew money because just they reinvested dividends, but the funds didn't have any particular success. You may also see excess turnover from the underlying funds, creating capital gains that may be taxed at regular income, depending on length of ownership. They're really just not a great fit for taxable accounts.